Hello and welcome to our webinar on group accounts. In today's webinar we'll be looking at the accounting requirements of IFRSs 10, 11 and 12 and IASs 27 and 28. In 2011 the IASB issued what they referred to as a suite or package of 5 standards which comprised IFRSs 10, 11 and 12, three brand new IFRSs, and 2 amended IASs, being IAS 27 and IAS 28. The intention or the purpose of these standards was to govern the accounting requirements under IFRS for different types of interests in other entities, which gives rise to what we refer to as group accounting requirements. This decision tree summarizes the interaction between these 5 standards, and basically if an entity has an investment in another entity, it's required to determine what type of influence that entity has in the investee. If that investor has control over the investee, then it would consolidate the investment under the requirements of IFRS 10 and produce consolidated financial statements. If the investor doesn't control the investee by itself, but shares joint control with another entity, that gives rise to a joint arrangement, which under IFRS 11 would either have to be classified as a joint operation or a joint venture with the appropriate accounting that goes with each type of joint arrangement. If the investor doesn't share joint control with anybody else but has significant influence in the investee, that gives rise to an investment in an associate, which is equity accounted under the requirements of IAS 28. And if there's no influence whatsoever, then that investment is accounted for as a financial asset using the requirements of IFRS 9 when that standard comes into effect, or until then as a financial asset under IAS 39, the standard on recognition and measurement of financial instruments. We start our journey through the group accounting standards by looking firstly at IFRS 10, the standard on consolidated financial statements. IFRS 10 replaces the previous version of IAS 27, which dealt with consolidated and separate financial statements, and as a contrast in the requirements of the previous standard and the new standard, it introduced a new and improved definition of control, explaining under what circumstances an investor would control an investee, and also introduced new exceptions to the principles of consolidations in comparison to its predecessor standard, which only had limited areas where an investor would be exempted from preparing consolidated financial statements, in terms of which all of the subsidiaries would be consolidated. The overriding principle upon which IFRS 10 is based is that an entity that controls one or more other entities is required to present consolidated financial statements. That principle has always been in previous versions of IFRS, or rather IAS 27, and that principle carries forward into IFRS 10. If an investor has control, there are limited areas where that investor would be exempted from preparing consolidated financial statements. One such exemption applies under the circumstances where an entity has control of a post-employment benefit plan, but if that post-employment benefit plan falls within the scope of IAS 19 on employee benefits, then we would rather look to that standard for the accounting requirements, in which case the investor would not consolidate that subsidiary or that controlled entity. The other general exemption, which was available even in the previous standard, was on a more general basis, provided the investor met 4 specific conditions, it would be exempted from having to produce consolidated financial statements. The 4 requirements are that the entity itself must be a subsidiary of another entity, and all of its shareholders must approve for the exemption from consolidation to be applied. The entity itself must not have any debt or equity instruments that are traded in the public market, nor should it be in the process of issuing any class of instruments for listing in a public market. And finally, the entity's ultimate or intermediate parent must produce IFRS compliant financial statements, in which presumably the entity itself, as well as any controlled entities, would ultimately be consolidated. Looking at what that exemption effectively says is if one considers a simple vertical group such as the following, where you've got an ultimate parent that controls an intermediate parent and the subsidiary down at the bottom of the group, provided all four conditions are met, the intermediate parent expectations in this instance would be exempted from having to produce consolidated financial statements. It should be noted that this is an optional accounting policy choice, so there's nothing that says that expectations must apply the exemption. It can still produce consolidated financial statements should it so wish, but the exemption is available if the feeling is that producing consolidated financial statements in this group structure would not produce any or not yield any useful information at the intermediate level. Just to repeat again, expectations would only qualify if it itself is a subsidiary of another entity. In this case, it is a subsidiary of Great Returns. And we assume that the other 45% of the shareholders, the non-controlling interests, have no objections to the exemption being applied. As long as expectations itself is not listed, debt or equity instruments, it's not in the process of obtaining such a listing, and as long as expectations will ultimately be consolidated into the IFRS financial statements of Great Returns, then expectations would be exempted. Areas where this would not necessarily always be available would be where, for example, Great Returns does not report in terms of IFRS, but perhaps in terms of some other reporting framework, perhaps US GAAP or some other type of local GAAP. Then under those circumstances, the exemption would not apply. Or if expectations itself has any listed debt or equity instruments. Note as well that it doesn't matter if Great Returns is listed or unlisted, the exemption is considered at each applicable level of the group. Unlike the previous two exemptions which were carried forward from IAS 27, IFRS 10 introduced a new exception to consolidation. Now note that I use the word exception here and not exemption. This is not an accounting policy choice. This is a new exception to the objective of IFRS 10, which says that if I have control, I must consolidate. If I am an investment entity by definition, then I may not consolidate any subsidiaries that I have control over, but instead I would need to account for my investments at fair value through profit or loss. This exemption or exception applies based on the nature of the investor, and we need to look to the definition of an investment entity to understand under what circumstances this exception would apply. The definition of an investment entity is any entity that obtains funds from one or more investors for the purpose of providing investors with investment management services. It commits to its investors that its business purpose is to invest funds solely for returns from capital appreciation, investment income, or both. And it measures and evaluates the performance of substantially all of its investments on a fair value basis. These three elements of the definition of an investment entity are all or nothing. So an entity must meet all three elements, otherwise it is not an investment entity by definition. And therefore, under those circumstances, if you don't meet the definition of an investment entity, the only possible way you can be exempted from consolidating a subsidiary is if you meet all four criteria of the previous general exemption from consolidation that we spoke about a moment ago. In deciding whether an entity is an investment entity, this is not an accounting policy choice. It's not something that an entity can designate itself to be an investment entity simply to avoid consolidation. One must consider all of the facts and circumstances, including the purpose of the investor and its design. And we look to the substance over the legal form, and the standard goes into some detail on explaining these elements in more detail. Firstly, looking at the business purpose of the entity. The standard says that an investment entity must invest funds solely for capital appreciation, investment income, in other words, the passive forms of income, rather than getting involved in other revenue sources. So it's not involved in selling goods or rendering services. The sole source of income is effectively to earn dividends income, interest, or rental income. And this is typically demonstrated by looking at how the entity portrays itself to investors, to the markets. So typically one would look at what information is in the circulars and other publications. The idea here is that it's providing investment related services. And if it's looking at providing investment advisory services, investment management, investment support and admin services, those types of additional services are only permissible to the extent that they assist in maximizing investment return. If these other types of investment related services represent a separate substantial business activity, that would be very strong evidence that the entity itself is not an investment entity. Where you provide management services or strategic advice to an investee, or for example provides financial support to an investee, you need to be very careful, because if these types of activities occur, then that would also be typically disqualify an entity from regarding itself as an investment entity. Under those circumstances, those subsidiaries would then have to be consolidated again, except unless if the entity qualifies for the exemptions that we spoke about earlier. IFRS 10 also explains that a typical attribute of an investment entity is that it typically does not plan on holding assets indefinitely. And this makes sense if one considers unit trusts and investment vehicles out there. They would typically have some kind of an investment strategy that would specify under what circumstances they would enter and exit an investee or an investment. The exit strategy need not be formally documented to be able to illustrate this, but one would need to be able to identify certain areas in which it would typically exit from its investments. Examples would include where an investee gets to a point where it is now going to have an initial public offering, or a private placement, or a distribution to investors. That would typically be a trigger point for the investor to exit the investment and go and look for another investee at some point down the line. Whereas an investor that would typically hold onto the investments beyond that point might find that it would be very difficult to illustrate that it is acting as an investment entity, because the chances are that it's probably going to get a little bit more involved with its investees than one would typically expect from an investment entity scenario. It should also be noted that simply saying, well, we would exit if there's a default or a breach, or where the investment isn't performing, is typically not strong enough to say, well, we've got an exit strategy. You'd need to be able to show somebody asking the question, are you an investment entity? Well, we would exit where we believe we would maximize our return, rather than simply waiting for a worst case scenario and deciding to exit at that point. Looking at the nature of earnings, I made the point a moment ago that it would be typically in the form of passive income. Any other benefits that the investor can look to that it could then earn from its involvement with this investee would typically also point to a situation where there's something beyond just the passive income that is a requirement of the classification as an investment entity. So instances where, for example, the investor has access to assets and technology of the investee, or arrangements to develop or produce or market products and services, or where there's financial guarantees and collateral that may be accessed as a result of the involvement or the investment, options to related parties to purchase ownership interests, and transactions on terms that are not typically market related or at arm's length, would be strong evidence to suggest that the investor is benefiting in ways other than the typical dividend, interest and rental income that one would expect as an investment entity. The last aspect of the definition talks about fair value measurement, and typically an investment entity would actively be monitoring the fair value of its investment portfolios, looking at other forms of assets that it holds as well. And so one would expect then that fair value information is reported to users, to shareholders and other stakeholders, and in most cases where IFRSs would typically offer either a fair value accounting policy option or a cost model to account for a particular asset or liability, you typically find that an investment entity would usually opt for the fair value measurement, because that is what drives the business. That's what they monitor, that's what they act upon, that's how they earn their income. So one would expect then that a true investment entity would typically have applied the fair value model to any investment properties that it holds. It would have invoked the exemption from equity accounting under IAS 28 to apply fair value, We'll talk about that in just a moment. And any other financial assets would typically be designated into a fair value category, even though they might otherwise have qualified for amortized cost or some other accounting. Note that it's not necessary to have everything at fair value, so you don't need to have your property, plant and equipment at fair values and things like that, but one would look to investment type assets as falling into the fair value options, because that is a hallmark of an investment entity. And then just some additional guidance in this respect. The standard says that typical characteristics of an investment entity are that it would typically hold more than one investment. It would be difficult to justify calling yourself an investment entity when you've got all your eggs in one basket. The nature of investment entities is such that they have diversified portfolios or have additional investments where they so that they can also leverage the one off against the other one. There are instances where a startup investment entity might only have one, but one would typically expect that number would grow over time. And likewise, one would expect them to also typically have more than one investor. That's again not an absolute necessity, but one would expect that an investment entity typically has more than one investor. Those investors are typically also unrelated, and ownership interests are typically in the form of allocated shares. That would be the typical nature of an investment entity. So to summarize, if you are an investment entity, by definition, you would then not be required to consolidate your subsidiaries, any entities that you happen to have control over, but instead you would account for those interests at fair value through profit or loss. Going back to the objective of IFRS 10, as I said at the start of this webinar, IFRS 10 says an entity that controls one or more other entities is required to present consolidated financial statements, with the exception of the exemptions that we've discussed and the exception to consolidation under investment entities. IFRS 10 also introduces a new and improved definition of control in comparison to its predecessor, IAS 27. Under IFRS 10, an investor controls an investee when it is exposed to or has rights to variable returns from its involvement with the investee, and it has the ability to affect those returns through its power over the investee. Taking that definition and breaking it down to its three important elements, we see that the three elements of control include power, exposure or rights to variable returns, and the ability to use power over the investee to affect the amount of returns. If any of these elements are missing, you don't meet the definition of control. And then going back to our original decision tree, we'd need to see, well, what other type of influence we might have to decide how to account for this. But we would not be consolidating, because if you don't meet the definition of control, it doesn't matter whether the exemptions are applied to you or not, you will not be consolidating. Consolidations only go hand in hand with control. Let's look at each one of these elements in more detail. The first of the elements is power. Now, power exists when an investor has existing rights that give it the current ability to direct the activities that significantly affect an investor's returns. Power can arise from voting rights, from equity instruments. So in a typical scenario where you've got a company that has share capital and shares that are issued to shareholders, if one share equals one vote, then power would typically rest with the entities relative to their voting rights represented by their shareholding. But power doesn't necessarily only come from shareholding. You can also have power because of contractual arrangements in place, either between the investor and the investee, or you might have power as a result of arrangements with other investors. So you might not have changed anything in terms of entered into any contracts with your investee company, but if you've entered into arrangements with other shareholders whereby they've given decision making over to you, depending on the circumstances, you could end up with power for purposes of this element of the definition. You can also have power from the current ability to direct the relevant activities, even if those rights have yet to be exercised. I'll talk more about that in just a moment. The explanation of power refers to relevant activities. Now, relevant activities are the activities that most significantly affect the returns of the investee. So one needs to look to what rights you have over what types of activities, what decision-making ability you have to allow you to make decisions unilaterally. That's typically what power means for purposes of this definition. Unilateral power means I can make decisions without having to consult anybody else. Whether I do consult with anybody else or not is irrelevant. I can still make the decisions by myself without having to do so with others. It might be that I've got decision making over certain activities and other parties have decision making over other activities. We would need to analyze the investee to looking at the different activities and what they relate to determine which of those activities are the relevant activities, the ones that most significantly affect the returns. And under those circumstances, we would then determine that we have power if our decision making is over the relevant activities. The standard also addresses the concept of protective rights. Protective rights are designed to protect the interest of the party that holds those rights without necessarily giving that power over the entity to which those rights relate. Consider the following example. We have a situation where the board of directors of Retail Holdings have decided to restructure the entity and dispose of a major subsidiary that accounts for 80% of the revenues and assets. In this particular instance, the issue will require the approval of shareholders holding at least 75% of the voting rights. Now, one of the shareholders, a minority in this instance, has a 15% stake in the group. They also happen to have what we refer to as a golden vote, and they are unhappy with the proposed transaction. Now, for purposes of this example, assume that the golden vote is a blocking vote. They can block certain decisions that they feel aggrieved or unhappy about, and therefore that decision cannot go through if they exercise the golden vote. Now, under the circumstances, the question that's asked is, would wholesalers, having regard to the fact that they've got this 15% stake as well as this golden vote, would we then say that wholesalers has control over Retail Holdings? Now, in analyzing this simple example, and without stretching for more information than what's available to us, we can see over here that there's the golden vote kicks in for certain types of decisions. And the purpose of the golden vote is if I'm a minority shareholder such as wholesalers and I'm unhappy about a transaction, I can go back and say, you know what, I block this decision. I don't want this decision to go through. I'm exercising my golden vote. But wholesalers doesn't have the ability to dictate what should be done instead. At least that's not what's apparent from the fact pattern. They can block certain courses of action, but they can't turn around to the other shareholders and say, instead of this decision that I'm blocking, I direct you to perform a different action or a different direction or a different type of transaction. All I can do is I can block certain courses of action. And that would mean that under the circumstances, this golden vote is a protective right, but the protective right does not give control. IFRS 10 explains it further by saying that typically protective rights relate to fundamental changes to the activities of an investee or apply in exceptional circumstances. In our example, it was only certain types of transactions that would make the golden vote exercisable. They are usually designed to protect interests of the holder without giving that party power over the investee. And because they don't give power, a holder of a protective right in and of itself cannot have control of an investee. Nor does that protective right take away power if another party has power and meets the other elements of the definition. So in our example, if on the other side of wholesalers there was another party that held the remaining 85%, although that line of action might be blocked by wholesalers, the 85% shareholder could presumably go and undertake any other transaction that would not invoke the golden vote or would not trigger the golden vote being exercisable, and therefore might still be able to demonstrate power. Earlier I mentioned that the explanation of power also considers voting rights that have, or contractual rights that may not yet have been exercised. So under the circumstances where, for example, I might have options to acquire shares or convertible bonds, loans, or convertible preference shares, to what extent would we consider potential voting rights in determining power? The standard tells us that you need to consider the impact of any potential voting rights that are currently exercisable at the reporting date. In other words, if I've got a situation where I hold options to acquire shares in an investee, as of the reporting date, I have not yet exercised the options, but those options are currently exercisable at the reporting date where I'm making this assessment of control. I would need to consider all facts and circumstances in deciding whether or not I will have power if those options were exercised, with the exception of management's intention and the financial ability to exercise or convert. Those are the only two aspects of the decision, or the facts and circumstances, that are disregarded for purposes of making the decision. And the standard basically takes this view to say, well, if the decision is important enough, if the entity would, if pressed in a particular circumstances, find that it would then exercise the option, and if the exercise of the option would give it enough voting rights that it would have power over the investee, then the thinking is, well, if the decision is important enough, then those options or those potential voting rights would be converted into voting rights, and therefore one could end up with power. So power isn't about what decision making you currently, or what decision making rights you currently have, but what decision making rights you could have based on the fact that the options are presently exercisable if you were to exercise the options. If the options only become exercisable in 6 months' time, then at the reporting date today, if this is when I'm making the assessment, then I disregard it, because under those circumstances, I would never be able to make any decisions as of the present moment, as of this moment in time. But if all I need to do is basically pick up the phone and say, oh, well, I'm now exercising my rights, give me my shares, I could in theory then make decisions based on the voting rights that I would then have if those voting rights are exercised, and that would then be taken into account in determining whether I've got power for purposes of the definition of control. So that concludes our discussion on power. The next element of the definition of control focuses on exposure or rights to variable returns. Now, this concept is rather broad. The obvious examples that one thinks of when one thinks of returns as an investor are things like dividends, interest, management fees, commissions, royalties, you name it. But those are the monetary returns that one can quantify and see in the inflow of cash and other types of benefits. But variable returns has a broader meaning than just monetary benefits. It can also include things like access to intangible assets, strategic benefits that might emerge as a result of having this relationship with the investee. So you need to consider once again all of the facts and circumstances in deciding whether you have exposure or rights to variable returns. The standard also tells us that the variable returns can either be positive or negative, or a combination of both. So unlike the previous definition, which focused on benefits, which one might have been tempted to think of only the positives and never the negatives, the concept of variable returns can be both beneficial and negative depending on the circumstances. Whatever the investor identifies as returns, one that would then need to ask, well, what would typically give rise to a variation in these returns? And although the returns might be to a large extent dependent on the state of the economy and external factors, it would be the entity's ability to intervene or to respond to external factors such as the economy and the markets, which would then take us to the third element of the definition of control, which is the ability to use power to influence the returns. If the investor is able to respond, well, either to directly intervene and say, well, we will now enter a new market, for example, and that gives rise to new opportunities, by changing strategic direction, that could give rise to, or that could affect the returns that the investor is entitled to or might expect to earn from its involvement with the investee. By the same token, the entity might be in a position to respond respond to challenges, so in times of recession or in economic downturns, by being able to, for example, cut costs, that can also have an impact on the returns that the investor is then ultimately entitled to. So any way in which the investor is able to, through its decision-making ability represented by the power, affect the returns, that would be the third and final element in the definition of control. And an investor that has power and is able to use that power to affect the returns will have control for purposes of IFRS 10. The standard cautions us that meeting the definition of control might not necessarily automatically mean that you've got control. The standard explains that in some instances, an investor might be acting as an agent on behalf of somebody else. In assessing whether you are acting as a principal or an agent for purposes of the definition of control, you would need to determine the scope of your decision-making authority over the investee, consider the rights held by other parties, consider the remuneration to which you're entitled by agreement, and your exposure to variability of returns from any other interest that you might hold in the investee. Consider the following example. Here we've got a trust that appoints a management company to run one of its investment entities. So in this example, we've got the trust and this management company being both investors in this investment entity. The management company is a 30% shareholder and the trust holds the other 70%. The management company is paid fixed and performance fees in relation to the services that it provides, and this, together with its return that it gets as an investor, gives rise to exposure to variability in return. Hercules has the right to remove the management company if it so wishes. So, applying the definition of control, the management company, Spartan, would have power in the sense that it has decision-making ability that it can exercise over the day-to-day runnings of the investment entity. It can decide how it wants to account for the or how it wants to deal with the operations of the investment entity. It has exposure to variable returns, and one could argue that it also is able to use its power to affect the returns it's entitled to. Its decision making will ultimately affect the amount that it gets, both through its performance fees as the management company, as well as an investor that would be earning dividends from the returns of the investment. However, it's that last bit over there that says that the 70% shareholder has the right to remove the management company if it so wishes, which is what this whole issue of agent and principal is all about. Under the circumstances, the power that the management company has been given has been delegated to it by the party that actually has power. And even though the management company might be seen to have signed away its power, by virtue of the fact that it can take it back at any point in time, that would indicate that the management company is acting as an agent under the circumstances. And even though one could maybe try and squeeze the definition of control into this scenario, Spartan would not have control over the investment entity. So that is the new and improved definition of control. And just to repeat again, if you have met the definition of control and you do not qualify for any of the exemptions or exceptions to consolidation, then in terms of IFRS 10, you would have to consolidate any entity that you control, what we then call a subsidiary. Insofar as the actual process of consolidation is concerned, there's no change from what's been done for many, many years. So IFRS 10 didn't change any of the consolidation principles. In summary, consolidation involves bringing all of the assets and liabilities, equity, income, expenses, and cash flows of the controlled entities, of the subsidiaries, together with the parent's own assets, liabilities, income, and expenses. So we bring all of these things together into one big pot. We eliminate any intra-group transactions, balances, income, and expenses entirely. So if there are some people refer to as intercompany, intra-group transactions, if any of those transactions have happened during the year, those would need to be eliminated in full. The investor, the parent, would have to apply uniform accounting policies. Regardless of what accounting policies have been applied by the subsidiaries, the investor would have to account for the assets, liabilities, income, and expenses, effectively all of the transactions and balances, using its own accounting policies to achieve a uniform set of accounting policies. As far as the reporting date is concerned, the idea is that this consolidation happens as of the same date, as far as possible. The standard is a little bit lenient. It says, well, if you, for example, have a subsidiary that's got a reporting date that's no more than 3 months different to that of the parent can use the different reporting date of the subsidiary and make adjustments for the effects of any significant transactions during that 3-month period. And as long as that same process is followed year after year, then you shouldn't end up with an answer that's materially different from what you would have gotten if you'd used the same reporting date for the entire group. But if the difference is more than 3 months, then you cannot apply that expedient, and you would have to use whatever information is available, whether it's management accounts or perhaps ask the subsidiary to change the reporting date. That's a decision that would have to be taken on a case-by-case basis. Non-controlling interests, which used to be referred to as minority interests in the past, are accounted for as a separate component of equity. So this is the amount of the net assets of the controlled entity that does not belong to the parent as such. So it's basically the outside shareholders' interest in the group. This non-controlling interest, by virtue of the fact that it's an equity component, means that any transactions between non-controlling interests and the parent company are accounted for as equity transactions, meaning that if a parent has control, so let's think of an example where a parent has, say, 60% of a subsidiary, the other 40% is represented by non-controlling interest. If that parent acquires a further 10% stake in that subsidiary, taking the interest from 60 to 70%. The parent has control at 60%. The parent still has control at 70%. Control is absolute. There's no different degrees of control, meaning that as a result of there being no change in control, that additional 10% is simply a transaction between the non-controlling interest and the parent. It's an equity transaction in its entirety, so we will simply account for an adjustment between the different components of equity with no profit or loss recognized, no additional goodwill, no adjustments to goodwill recognized as a result of that. And similarly, if the parent that has 70% sells off, let's say, 15%, it had 70% control at that point in time. It now still has control at, say, 55%. Under the circumstances, it's simply an equity transaction. We'd give more to the non-controlling interest in equity, and any difference between the amount of cash exchanged and the level of equity that's been transferred to NCI will likewise remain in equity. No gain or loss on partial disposal or anything like that. The only time a parent would ever recognize a gain or loss in respect of a subsidiary is if it loses control of a subsidiary. Now, an entity can lose control through various means. We spoke earlier where we said, well, power typically is represented by shareholding, and one would assume that if I sell enough shares, then I might end up losing control. But I could lose control without selling a single share. I might still have the same remaining interest in the subsidiary, but I will have lost control if I've either signed it away contractually in a way that does not allow me to take it back. You know, in the example I gave earlier, where I've delegated control. If I've delegated control in such a way that I cannot take it back again, then I will have lost control, even though I might not have sold a single share or changed my relative shareholding in the subsidiary. Likewise, I could lose control if, for example, the subsidiary is placed under judicial administration or into business rescue or whatever the case might be, where decision making is taken away from me. I might be 100% shareholder, but I cannot exercise any decision making, and under those circumstances, I will have lost control. And if I lose control, then I would have to de-recognize the assets and liabilities that I've previously been consolidating. I would have to recognize any remaining investment at fair value, based on whichever standard is applicable. So if I end up with no decision making, no influence whatsoever, then I could end up with a straightforward financial instrument under IFRS 9. Or if I end up with an associate or a joint arrangement, I might have to equity account that under IAS 28, as the case might be. But for purposes of this loss of control event, I will have to measure that remaining investment that I have, if any, at fair value. And then I will also have to consider any consideration that I've received as a result of this. So if I've sold shares, whatever proceeds I've received as consideration for the sale of shares, I'll compare that to the value of the assets and liabilities that I've given up, as well as the value of whatever remaining investment I might still have, and I will calculate a gain or loss that is associated with this loss of control. That gain or loss is recognized immediately in profit or loss, regardless of the quantum thereof. It may be that I was not an investment entity before and I become an investment entity at some point. So that would typically arise because of a strategic change in the manner in which I run my business. If I become an investment entity, you'll recall an investment entity may not consolidate. There's no choice involved there. So that would be accounted for similarly to a loss of control, because effectively I will remove the assets and liabilities that I've been consolidating and in turn start accounting for an investment at fair value through profit or loss. And any gain or loss that is recognized as a result of that is likewise recognized in profit or loss. If I was an investment entity and I cease to be one, in other words, my status has changed because perhaps once again strategically we started getting more involved, we're providing more services that are not in line with what one would expect from an investment entity. At that point in time, the investment that was previously being fair valued through profit or loss will now have to be consolidated under IFRS 10 unless I qualify for exemption from consolidation. But I would then have to account for, I'd have to account for a business combination as a result of these new assets and liabilities that are suddenly going to end up on my balance sheet. And the change of status date would be regarded as the deemed acquisition date under IFRS 3. And the fair value of the investment immediately prior to the change in status would be regarded as the deemed consideration, and any difference between the consideration transferred and the fair value of the assets and liabilities that I'm now consolidating will be accounted for as either goodwill or a gain on a bargain purchase. Any disclosures to do with investments in subsidiaries are dealt with in terms of IFRS 12, which we'll talk about in just a moment. So we've just spoken about consolidations under IFRS 10. If I don't have control, if I don't meet the definition of control, and I've got an interest in another entity, my next question to ask is, well, do I have joint control? Or failing that, do I have significant influence? I'll deal with these two aspects, these two levels of influence together, because you'll see that there are some overlaps between the two issues. But if I've got joint control, I will apply IFRS 11 to determine what type of arrangement I've got. And if I've got significant influence, I will apply IAS 28 for purposes of the equity accounting that's required. IFRS 11 replaces the previous IAS 37, which dealt with joint ventures, and IAS 28 has been amended to incorporate certain consequential aspects, consequential changes as a result of these new IFRSs that have come about when this package of 5 standards was issued in 2011. Some important definitions to understand the next couple of slides. A joint arrangement is just defined as an arrangement of which 2 or more parties have joint control. And joint control is explained as the contractually agreed sharing of control of an arrangement, which typically requires any decisions about relevant activities. Remember, relevant activities are those activities that most significantly affect the returns of the investors. Decisions about relevant activities require unanimous consent of the parties that share control. An associate is an entity over which the investor has significant influence, and significant influence is defined as the power to participate in financial and operating policy decisions, but is not control or joint control. Starting with the definition of significant influence, that remains pretty much unchanged from what was under the previous version of IAS 28. Typically speaking, a significant influence means that you've got a say in certain of the decision making, in that you participate in the process, but you alone cannot sway the outcome. Your voice may be heard and taken into account by those who will ultimately make the decisions, whether that's an investor that has control by itself or whether it's parties that share joint control. but you yourself cannot sway the outcome directly. You simply make suggestions or you participate in the process, and your voice may or may not be heard. Significant influence typically kicks in where an investor typically directly or indirectly has 20% or more of the voting power of the investee, unless it can be clearly demonstrated that this is not the case. It's a rebuttable presumption. So if I've got 20% of the voting power, but I can demonstrate through supportable reasons why I believe that I do not have significant influence under the circumstances, then you'll see later on that's one of the things that I'd have to disclose, the reasons why I believe that would be the case as part of my significant judgments. That being said, the fact that somebody else might have control or might have joint control in the investee doesn't take away my ability to have significant influence. Significant influence doesn't only apply to shareholding, so it's not just based on 20% or more of the voting rights, but if I've got contractual arrangements that give me representation on the board or the ability to participate in decisions relating to material transactions or any other kind of policy making, decision making that I have, or perhaps I engage in material transactions with the investee such that I would then be regarded as being able to perhaps have some form of influence in the decision making, then I could also meet the definition of significant influence. Joint control is perhaps a little bit more blatant, but again, judgment may be required in certain circumstances depending on depending on the particular situations. Joint control means that all parties that share joint control must act together. So joint control is not about democracy. In most democracies, you know, the biggest party will have the decision making. Here, it's not about the size of the investors or the size of the shareholding, but rather on the basis that no decisions can be made without all parties that share joint control being in agreement. In other words, unanimous decision making is the outcome of this. It doesn't just have to be between two parties. You can have joint control between multiple parties. There's no limit imposed on the standard in terms of how many parties would be able to share joint control. And likewise, it doesn't have to apply to everybody in the arrangement. You could have an arrangement whereby there are perhaps 4 or 5 investors, but the arrangement is structured in a way that 2 of the investors have to vote together to get any decision made, any relevant decision made in terms of this particular arrangement. Under those circumstances, the 2 parties that must act together would share joint control. The other parties would be excluded from joint control, and they would then need to apply the decision tree to decide which standard they need to apply to their investment given their relative voting rights that they have in the investee. So for example, an excluded party from a joint arrangement might still have an associate because it might have significant influence in the arrangement, for example. The nature of joint arrangements is such that the arrangement might change over time, or relative shareholdings might result in a situation where a joint control suddenly manifests where it wasn't there before. But again, one would need to be constantly alert for any change in facts and circumstances to consider whether joint control still exists or now exists where it might not have existed previously, or perhaps no longer exists depending on the circumstances. Once I've determined that I have joint control, IFRS 11 explains that there are 2 types of joint arrangements, and once again judgment is required to determine what type of arrangement we've got. This isn't an accounting policy choice. You can't say, well, I choose to have a joint operation or I choose to have a joint venture. A joint operation exists whenever a joint arrangement results in a situation where the parties that share joint control have rights to the assets and obligations for the liabilities of the arrangement. And by contrast, the joint venture exists where the parties that share joint control have rights to the net assets of the arrangement. And those parties are called joint venturers. The standard provides some guidance in this regard. It says, well, when we consider the structure of the joint arrangement and what type of arrangement you've got, if you've got a joint arrangement that is not structured through a separate vehicle, that will typically automatically get you to a joint operation classification. Where you've got a separate vehicle in place, then you need to consider what is the legal form of the separate vehicle, the terms of the contractual arrangement, and any other relevant facts and circumstances to decide whether you've got a joint operation or a joint venture. A separate vehicle is explained as a separately identifiable financial structure that includes separate legal entities or entities recognized by statute, regardless of whether those entities have a legal personality. So if you are able to ring fence a portion of a business or an activity, that would typically give rise to a separate vehicle for purposes of this assessment. But then you need to ask, well, given the fact that I can ring fence certain aspects of or certain activities, do I still have rights to the assets and liabilities of those activities, or do I have rights simply to the net assets? That will determine whether I've got a joint operation or a joint venture. As with the definition of joint control, it is possible that the arrangement can change its nature over time, particularly where new addendums to contracts are signed, or where the parties agree to a change in the way in which they're going to work going forward. So at all times, you need to consider whether facts and circumstances suggest that the type of joint arrangement may have changed at some point. This distinction between what type of arrangement we've got is quite important, because it determines the accounting that has to be applied by the party to the joint arrangement. If the joint arrangement is a joint operation, you'll recall we said that would mean that you're a joint operator. A joint operator would recognize, in relation to the interest in the joint operation, the operator's share of any assets held jointly, the operator's share of any liabilities incurred jointly, the operator's share of any revenue, and any expenses incurred jointly. Any intercompany transactions, any transactions between the operator and the joint operation itself, would only be eliminated to the extent of the operator's own share of the transactions with the joint operation. A recent amendment to IFRS, amendment to IFRS 11 and IFRS 3 on business combinations explains that if an operator buys into an existing joint operation, it's important for the operator to then determine whether that joint operation meets the definition of a business. And if it does meet the definition of a business, the operator will apply IFRS 3 on business combinations to account for the acquisition of that interest in the joint operation, which basically means accounting for its share of the fair value of the net assets of the operation as at the acquisition date. By contrast, a joint venturer, in other words, a party that has an entity that has an interest in a joint venture, will account for its interest in that joint venture using equity accounting in terms of IAS 28, which we'll discuss in just a moment. The previous standard on joint ventures, IAS 37, used to typically that was the benchmark or default treatment, used to say that if you've got an interest in a jointly controlled entity, you would have to you would apply proportion consolidation or use equity accounting as an allowed alternative treatment for your interest in that entity. IFRS 11 says there's no choice involved. If you have a joint venture, you must apply equity accounting unless you qualify for one of the exemptions from equity accounting, which I'll discuss in just a moment. Which takes us to IAS 28 on investments in associates and joint ventures. Previously, IAS 28 only applied to associates or to joint ventures in which the investor had opted to apply equity accounting instead of proportionally consolidating. The amended IAS 28, which we're discussing now, applies to all investments in joint ventures and associates. It also applies to investments in subsidiaries, associates, and joint ventures if in the investor's separate financial statements, if equity accounting is chosen as the accounting policy for that type of investment. I'll discuss that in just a moment when we look to IAS 27. Like IFRS 10, there are some exemptions from having to apply equity accounting. So the rule of thumb says if I've got significant influence in an associate or if I've got joint control of a joint venture, I must apply equity accounting. However, if I meet all four of the following requirements, and you might recognize these from earlier in this webinar when we discussed the general exemption from consolidation. If the investor itself is a subsidiary of another entity and all of its shareholders approve, the investor itself does not have any debt or equity instruments and are not traded in the public market, the investor is not in the process of obtaining such a listing, and the ultimate or intermediate parent produces IFRS financial statements in which the entity will be correctly equity accounted at that level, then under those circumstances, you would be exempted from having to apply equity accounting. So the same general exemption from consolidation applies to equity accounting. The second exemption is similar to the investment entity exemption, but it's not quite as strict. If you'll recall, the investment entity exception that we spoke about earlier said that there were 3 criteria that had to be met in order for an entity to call itself an investment entity. That being said, an investment entity would automatically be applying this exception that I'm referring to now, but you need not be an investment entity by definition. You can be a venture capital organization, a mutual fund, unit trust, investment-linked insurance fund, or similar entity. Most of these entities would typically meet the definition of investment entities anyway, but they need not meet the definition. This is now a choice. If you are such a similar type of entity and you opt to do so, you could, instead of equity accounting your investment in a joint venture or associate, you could opt to account for that investment at fair value through profit or loss using the requirements of either IFRS 9 or IAS 39 until IAS 39 is entirely replaced. If we assume that none of the exceptions or exemptions apply, the application of equity accounting is in some ways straightforward, but in some ways can also be quite complicated. Typically speaking, regardless of whether it's an associate or joint venture, the investment is accounted for initially at cost. Although the cost isn't defined in the context of equity accounting, one typically understands cost to mean whatever you paid for the investment, whether that's an investment in shares or some other form of interest, whatever it costs you to get that influence or joint control over the investee. If there's any difference between the cost and proportionate share of the net asset value that you are entitled to, so for example, if I'm getting a 20% interest in an associate, I would compare what that 20% entitles me to. Looking at what I believe the net asset value of the investee is worth, looking at my 20% share of that portion, and I compare that to what I paid. And if there's any difference between what I paid for the investment and what I've received in the form of value, I will effectively treat it as goodwill or a gain on a bargain purchase, similar to what we do with business combinations. However, unlike business combinations for acquiring a subsidiary or a control of a business, I won't recognize a separate goodwill amount on my balance sheet. With business combinations under IFRS 3, goodwill is recognized as a separate asset. In this instance, the goodwill is understood to form part of the investment in associate or joint venture. And as a result of that, there's no amortization required or permitted, and on top of that, there's also no need for separate impairment testing as would be required for goodwill that's recognized separately in a typical business combination. By contrast, any bargain purchase that you recognize or that you realize as a result of receiving more value than what you paid for would be recognized as income in profit or loss on acquisition. In the first year of equity accounting, you'll have a boost in the form of income from associate or joint venture, which also includes this element of a bargain purchase that you account for. Thereafter, the subsequent measurement of the equity accounted investment requires the investor to adjust the carrying amount of the investment to account for the investor's share of post-acquisition profits or losses, as well as other comprehensive income of the investee. For example, if the investee revalues property, plants, and equipment, your share of the revaluations will also adjust the investment from the perspective of the investor. However, it's important to note that the standard says you must make adjustments to account for your subsequent measurement of the investee's assets or liabilities based on their fair values at acquisition. So you can't simply take the investee's financial statements using its assets and liabilities based on historical costs if there's a difference between the fair values as at the acquisition date where the significant influence of joint control was established in comparison to the historical cost recognized in the investee's financial statements. Potential voting rights are taken into account in assessing whether you've got significant influence, but for purposes of equity accounting, you will only account for your share of the investee's assets or liabilities relative to your current voting rights. So if I've got, say, 20%, let's say I've got 10% of the voting rights, and I've got an option that is presently exercisable to acquire a further 20%. So if I was to exercise, I would have 30%, which takes me above the 20% threshold for significant influence. Although I haven't yet exercised those voting rights, if I was to exercise them, I would have significant influence, which means I meet the definition of an associate, but my equity accounting would be on the 10% that I currently have. Any intra-company transactions are eliminated to the extent of the investor's share in the investee. Similar to consolidations, we need to use the same reporting date with a practical expedient of no more than 3 months. And similar to consolidations, we need to use the appropriate, the same accounting policies. So any differences between the investee's accounting policies and the investor's accounting policies must be processed as part of the equity accounting adjustments. For example, if the investee revalues its property, plant, and equipment, but the investor doesn't, the investor cannot take the profit or loss as per the investee's financial statements, because that would be after for example, the depreciation on the revalued property, plants, and equipment, whereas any depreciation from the investor's perspective should be on the historical cost. So under those circumstances, the investor would have to adjust the profit or loss to remove the effect of any incompatible accounting policies. Effectively, the process of equity accounting is very, very similar to consolidation. In fact, IAS 28 acknowledges that and makes that comparison. The only difference between consolidation and equity accounting is that, unlike consolidation, where all of the assets and liabilities are brought into the investor's balance sheet and then remove the non-controlling interest in equity accounting, only the investor's share of the assets and liabilities, income and expenses, are brought into that single line item, investment in associate or joint venture. That investment in associate or joint venture must be tested for impairment wherever there's an indicator of impairment. We consider the indicators of IAS 39, for example, objective evidence of impairment, similar to indicators of impairment for debtors and other types of financial assets. If those indicators are present, we then test for impairment using the principles of IAS 36. And once again, to repeat, goodwill is not tested separately. We test the investment as a whole for impairment, which means that any impairment loss on the investment can be reversed subsequently should that be necessary under IAS 36. Like IFRS 10, all of the disclosures relating to joint arrangements and investments in associates are dealt with in accordance with IFRS 12, which we'll discuss in just a moment. IAS 27 used to be the standard on consolidated financial statements. It was called consolidated and separate financial statements. With the issue of IFRS 10, which took all the consolidation guidance into a brand new standard, IAS 27 has been reissued and only deals with separate financial statements. The standard doesn't explain which entities must present consolidated financial statements. That's left up to each jurisdiction. So different companies' act requirements in different countries might specify that investors must prepare both consolidated and separate financial statements. An entity can also opt to present separate financial statements voluntarily if there's no legislative or legal requirement to do so. But if it does prepare separate financial statements where there's no legal requirement to do so, it must disclose the reasons for doing so. Separate financial statements are basically additional information. It's the financial statements presented over and above the financial statements that are consolidated financial statements produced by a parent, in which an investment in a subsidiary, associate, or joint arrangement are accounted for in accordance with other requirements rather than the requirements of IFRS 10, IFRS 11, or IAS 28. Originally, IAS 27 allowed two options for separate financial statements. It said you can either use the cost model or the fair value model in terms of IFRS 9 or IAS 39. A relatively recent amendment also introduced the option to use equity accounting as in the separate financial statements, which means that an investor might produce consolidated financial statements in which the subsidiaries are consolidated, and in the separate financial statements it can equity account, or it can measure it at cost less impairment, or it can apply fair value measurement to the investment. That's an accounting policy choice. The choice isn't available on an investment by investment basis. It must be applied to each category of investments. So for example, subsidiaries can all be at cost less impairment, joint ventures can be at fair value, and associates can be equity accounted, should it choose to do so. If an entity is exempted from consolidation or from equity accounting using one of the exemptions under IFRS 10 or IAS 28, it would then present separate financial statements as the only financial statements. But if an investment in associate or joint venture is measured at fair value under IAS 28, the fair value model must also be applied in the separate financial statements. You're not allowed to use the cost model in the separates, nor can you use equity accounting in the separates if you've applied fair value accounting under IAS 28. For investment entities, an investment entity that fair values its investments in any of these other entities would have to present separate financial statements as their only financial statements, and similarly the fair value model is the only model that's applied there. And the disclosure requirements in terms of IFRS 12 must also be provided in respect of investment entities. IFRS 12, apart from the investment entities point on the previous slide, IFRS 12 does not apply to separate financial statements, but it does apply to, there are some IFRS 12 disclosures required for investment, for an entity that does not have a subsidiary, associate, or joint venture, in respect of, for example, unconsolidated structured entities, which I'll explain in just a moment. In separate financial statements, if the cost or fair value model is used, dividend income would be recognized in profit or loss as and when the investor receives the right to receive the dividend. If equity accounting is used, then the dividend is a reduction of the value of the investment because the profit or loss has already been included in the equity accounting. This takes us to the last portion of this webinar. We've covered the issues of consolidation, we've covered joint control, we've covered significant influence, and as I indicated at the start of this, if you don't have any form of control, joint control or significant influence, you would simply account for an investment in another entity as a financial asset using IFRS 9. What we have not yet covered is the disclosure requirements for these other interests in entities, consolidated financial statements or equity accounted financial statements, and that takes us to the brand new IFRS 12, which brings together all of the disclosure requirements of the other standards. Prior to these 5 standards being issued in 2011, each of the earlier versions of the standards had its own disclosure requirements dealing with the particular aspects of that issue. So for example, IAS 27 explained what disclosures were required in terms of consolidated financial statements, and IAS 31 did similarly to interests in joint ventures. IFRS 12 brings all of these together into a single standard. And the objective of IFRS 12 is to enable users to understand the nature and risks of interest in other entities and the effects of those interests on the financial position, financial performance, and cash flows of the investor. The standard applies to investments in subsidiaries, joint arrangements, both joint operations and joint ventures, associates, as well as a new concept called an unconsolidated structured entity. I'll talk about that in just a moment. It does not apply to any controlled defined benefit plans to which we apply IAS 19 for employee benefits. It doesn't apply to separate financial statements in general, although there are some instances where some disclosures are provided in certain circumstances, and it doesn't apply to an investment that's been accounted for under IFRS 9 or the predecessor standard IAS 39, financial instruments. Before we understand an unconsolidated structured entity, let's talk a little bit about what a structured entity is. IFRS 12 explains that some entities might be designed in such a way that voting or similar rights are not the dominant factor in deciding who controls the entity. So for example, any voting rights are token voting rights, but the decision making relating to the relevant activities is directed by means of contractual arrangements. Usually a structured entity would have similar features or attributes, usually restrictive activities, narrow and well-defined objectives, such as designed specifically for a particular purpose, effecting a tax-efficient lease, carrying out research and development, or providing a source of capital or funding to an entity or a group of entities, or by passing on risks and rewards associated with the assets of the structured entity to other investors. Usually, a structured entity has insufficient equity to permit the structured entity to finance its activities without support, and often the financing is in the form of multiple contractually linked instruments to investors that create concentrations of credit or other risks. It's important to note that you don't have to meet all of the structured entity doesn't have to have all of these features or attributes, but these are typical examples of structured entities. Examples where structured entities are found are for securitization vehicles, asset-backed financing, and some investment funds. Standard explains that an entity that is controlled by voting rights is not a structured entity simply because it receives funding from third parties following restructuring. There might be certain covenants that are linked to that funding, and that might give certain decision-making ability. That doesn't suddenly make this a structured entity, but one would need to consider, once again, all of the facts and circumstances. Now, if an investor or if an entity has an interest in a structured entity, the fact that it's a structured entity, if the definition of control is met, in other words, if there's power, if there's exposure or rights to variable returns, and the investor has the ability to use the power to affect the returns, the fact that it's a structured entity doesn't change the normal principles that we discussed earlier in this webinar. It is a subsidiary which is consolidated in terms of IFRS 10. The disclosures that we're referring to now in the context of structured entities, or more specifically unconsolidated structured entities, are as a result of the fact that you might have some kind of involvement with a structured entity by definition, and you have not met the definition of control, therefore you're not consolidating, and you may not have met the definition of significant influence, and therefore you're not equity account, or perhaps you might not have an equity interest in this entity, and therefore there's nothing to equity account. Remember, equity accounting would only result in would only emerge if you've got some interest in the equity that you can account for. So unconsolidated structured entities have so far remained off balance sheet. If they didn't meet the definition of control, or if there was nothing to equity account, that was the end of the story. These things kind of fell through the gaps. As a result of issues dating back to the Enron fiasco and the global financial crisis, US GAAP has been amended in recent years to require additional disclosures in respect of these off-balance sheet activities, and likewise IFRS has responded as well to require additional disclosures in respect of these unconsolidated structured entities. But we'll come back to those in just a moment. I'm not going to go through all of the detail of all of the disclosure requirements, because once you've determined what type of investment you've got, you can then look to the standard to see what the specific disclosure requirements are. I would just like to draw your attention to some of the disclosure requirements that are a little bit different or that require additional information. So one of the things that IFRS 12 says is you must, as the entity preparing the financial statements, as the parent or the investor, you need to disclose any significant judgments and assumptions used in determining whether you have control of another entity. Why did you consolidate if you don't have more than 50% of the voting rights typically? Or why did you consolidate where you're only a 10% shareholder, which is possible? For example, whether you've got joint control, what type of joint arrangement you've got, or why you believe you've got significant influence or not, as the case might be. Where you've used a different reporting date, if you'll recall when we discussed consolidation and equity accounting, I said that as a practical expedient you can use different reporting dates as long as those dates are no more than 3 months apart. You'd simply need to disclose what the difference in dates is and the reasons for using the different dates or periods. Those are the general disclosure requirements of IFRS 12 that apply to all types of interests. Looking specifically on a category by category basis, the standard has got specific disclosure requirements for subsidiaries, specific disclosure requirements for joint arrangements, and specific requirements for associates. Typically, the disclosures focus on the nature, extent, and financial effects of the interest, as well as the nature of and changes in the risks as a result of our involvement. For example, some new disclosure requirements that were not required prior to IFRS 10 are the requirement to disclose summarized financial statements of any subsidiaries where there's a material non-controlling interest within the group, which was never required previously. Other factors are, for example, explaining the group structure and so on. And similarly for investments in associates and joint ventures, once again, summarized financial statements of material joint ventures, joint arrangements, and summarized financial statements of material associates, as well as any balances between the parties, any intercompany receivables, for example, and additional disclosures around the risks relating to those. Lastly, the standard requires additional disclosures in respect of unconsolidated structured entities. There are qualitative and quantitative disclosures. So, for example, looking at what the purpose of this entity is, what the nature of the involvement with by the reporting entity is with this unconsolidated structured entity, any balances in the form of loans that have been advanced, any commitments to provide loans, the reasons why financing has been provided where it was not required. So, for example, where the reporting entity has sponsored the unconsolidated structured entity, and so on and so forth. I strongly encourage you to look to the disclosure requirements because it's not to say that all of the disclosures of IFRS 12 are applicable, but they are different in many respects to what would have been required in years gone by. Lastly, we look to the summary of what we've discussed in this webinar. So this last slide over here explains to you at a high level, and there can be exceptions to this, but at a high level it gives you an idea as to what type of accounting goes with the different levels of influence. So starting from the left hand side over there, if you've got less than 20% and no other funny contractual arrangements in place, one would assume that all you've got is a straightforward financial asset, an investment in another entity. Looking to IFRS 9 or IAS 39, one would probably end up with a fair value accounting, either fair value through profit or loss or fair value through other comprehensive income if certain designations are made under those standards, and the disclosures governing those are typically found in IFRS 7 on disclosures of financial instruments. Moving across to the second block over there, we've got an investment of between 20% to say up to about 50%. Technically, there's no limit, but at higher levels, one typically then ends up in one of the other categories of investments. So where you've got significant influence, you've got an associate, which you have to equity account under IAS 28. In the separate financial statements, you can choose between cost, fair value, or equity accounting, and disclosure is provided in terms of IFRS 12. At 50%, control typically kicks in, or rather 50% plus 1, unless there are any other funny arrangements, because usually the majority shareholder would be able to demonstrate the definition of control having been met. And therefore, we account for a business combination up front, but then consolidate the assets and liabilities of the subsidiary, and in the separate financial statements, cost, fair value, or equity accounting, and disclosures in terms of IFRS 12. And lastly, where there's unanimous consent, on this graphic over here, it's on the right hand side, but it applies at any level of investment. If you've got a contractual arrangement that requires unanimous consent, that joint arrangement needs to be accounted for either in terms of IFRS 11 as a joint operation or equity accounted under IAS 28. And once again, in the separate financial statements, cost, fair value, equity accounting, and disclosures in terms of IFRS 12. That concludes our webinar on group accounting. If you do have any questions that we haven't answered yet, please feel free to submit them and we will answer them as best as we possibly can. This webinar, and we look forward to seeing you in a webinar going forward. Thank you and enjoy the rest of your day.